Is quantum computing a buy or a sell? Let's get started with the model. This is a small cap company, 307 million market cap. They're trading at $3.10 a share, and they have 99 million shares outstanding. Quantum computing is an integrated photonics company that offers affordable quantum machines. It was incorporated in 2018, based in Hoboken, New Jersey. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Since they IPO'd, they have not even generated $1 million of revenue. So of course their free cash flow and net income are negative every single year. They're currently at $400,000 of revenue in the trailing 12 months. Same thing in 2023. $100,000 in 2022. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $820 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $451 million. We divide that by 99 million shares. And we get a calculated stock price of $4.56. They're trading at $3.10, so they're trading at a 32% discount. It's a buy according to the model. They're pretty much pre-revenue. So it's really hard to value this company. I'm assuming they're going to get the $100 million of free cash flow by 2027. That assumption is based over the company's projections, analyst projections, and what percent of the market they can capture. It's definitely real risky, but if they succeed, you can make a lot of money since the stock is so cheap now. There are 33 companies in the same industry as quantum, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, $3 million. They're still a really small company. They have a good debt to equity ratio, 0.1. Negative free cash flow, of course. Their market cap is $300 million. It went down a lot yesterday. We'll talk about that in a little bit. Price to book is 3.2. That's stock price over book value per share. We can't look at a PE or price to free cash flow. Price of sales is really high because their revenue is so low, only $400,000. And their 52-week low is 42 cents. Before last week, for about a year, they were trading below $2. Here's where the stock has been trading the past year. So a year ago it was 77 cents. Before last week, it got as high as $1.24. Then it was trading below $1 for about 6 months. As of November 12th, it was still $1.38. Then shot up to $4.40 on Thursday the 14th. On Friday, it came down a lot, down to $3.10. The reason for the big drop on Friday is because they're diluting shareholders. They're going to sell 16 million shares of stock at $2.50 each. Because when the stock price goes up, it's a good opportunity to sell more shares. It's better to dilute shareholders when the stock price is high than when it's low. So they're going to raise $40 million from that stock offering. They're going to use the funds for working capital, pay down debt, and general corporate purposes. This week, the company got its very first order for its photonic chip technology. Sales for the month is $101,000. Their estimate was $300,000, so they fell real short of that. You can see in the past year, the stock was down to 42 cents, and it broke through its 52-week high on Thursday. Logitech is the least volatile when you compare the 52-week low to the 52-week high. It's only a 25% spread. If you put $10,000 into this company 10 years ago, you'd have under $3,000 today, a 72% loss. To summarize, I have them trading at a 32% discount, ranking 2 out of 10. The only reason it's not a 1 is because they got their first order. Would I buy it short term and long term? 1 out of 10. Way too risky. Ratios look terrible, 1 out of 10. And financials, 1 out of 10. They have hardly any revenue. Let's look at their most recent quarterly earnings. Here's their income statement, the third quarter of 24, third quarter of 23. Revenue doubled from $50 million to $100 million. The two main reasons the stock got over $4 was its revenue went up. They had their best quarter ever. It's still just $100,000. But I think more so are their contracts. They have a contract with NASA and Johns Hopkins. This article talks about it. Quantum up 400% in the past month. It was as low as 71 cents up to 380. They have high-profile customers like NASA and Johns Hopkins. The quantum computing market is $1.2 billion this year. By 2032, $12.6 billion, a 35% CAGR. I doubt this company will get that much action. It mainly goes to the big guys, IBM, Google, Amazon, Microsoft, etc. But like I mentioned earlier, they got their first order, and that got a lot of investors wet. They did have positive gross profit. They had $9,000 of gross profit, so their margins were 9%. Last year, with $50,000 revenue, $26,000 gross profit, so margins 52%. But of course, they have negative operating income because they still have $2.2 million of R&D, $2.8 million of G&A. So a net loss of $5.7 million. Last year was a net loss of $6.8 million. Let's look at the balance sheet. Their current assets, $3.9 million. Current liabilities, $2.4 million. So a good current ratio. They have $3 million of cash. Their biggest asset is goodwill, $55 million. They do a lot of acquisitions. Their biggest liability is operating leases, $1.3 million. They lease 3 locations, one in Hoboken, New Jersey, one in Tempe, Arizona, and another in Arlington, Virginia. Their equity is $60 million. Equity is assets minus liabilities. They raised $210 million from selling their business. They lost $150 million from running their business. And they have negative operating cash flow, negative $12.4 million. Last year was negative $13 million. They spent $3.2 million of PP&E. Here's a breakdown of the PP&E, $6 million computer and lab equipment. Then they have network equipment, furniture and fixtures, software, leasehold improvements. So the gross value of their PP&E is $6.3 million. They depreciated $500,000. So the net value is $5.8 million. They raised $7 million from financial liabilities. This may be like a loan or something. They paid back $2 million of financial liabilities. They paid $200,000 of dividends on preferred stock. They bought back $2.7 million of preferred stock. They raised $15 million in ATM offering. Last year they raised $23 million. Let's look at Simply Wall Street. Its last price $310, 436 million market cap, up 117% in the past week, up 320% in the past year. Simply Wall Street does not have a valuation for this stock. There are no analyst price targets. They had no revenue in 2018, none in 2019, none in 2020. You guessed it, no revenue in 2021. 2022, 136,000. 2023, 358,000. And for the trailing 12 months, 386,000. Things are looking up for this company. I bet you the CEO's salary is more than their entire revenue. They don't really have much debt. The most ever was $8 million. Now it's $6.5 million. They have $60 million of equity, much more than their debt. They only have $3 million of cash. It's good they did a capital raise because they definitely need some cash. 70% of the company is owned by the general public, 1/4 by insiders, 4% by institutions. Their biggest shareholder is Yuping Wang, 24%. He's a professor at Stevens. He was able to get a $15 million contract with the U.S. Army. The next biggest shareholder is Vanguard, then the CEO. Their employee count has gone up a lot from 6 to 44, and the ticker trades on the NASDAQ. If you want to learn how to build a DCF model, click on the video in the top right corner. Thanks for watching.